What I said on the call, which is true, is that you have the cost to build hotels going up at a pretty rapid rate in the United States, cost of labor going up, cost of interest rates going up, and availability of money getting a little bit tougher or tighter. And the consequence of that is that you see supply numbers going down. Ultimately, that's healthy for the industry. We're already in 2018 sort of at a 30-year average, so not at particularly high levels of supply, and those numbers are expected to go down next year, which should be good for the industry, healthy and good for same-store results. The nice thing for Hilton is, because we have the strongest brands in the business, the highest average market share in the industry, while we're 11 and change of the U.S. industry, we have 25% of the rooms that are under construction in the United States bear a Hilton flag. And importantly for us, strategically, it's a big world. So things ebb and flow. This same thing happened during, and after the Great Recession. The U.S. market slowed down, other markets picked up, and that's sort of what's happening now. Is the U.S. market, from a development point of view, is slowing down, but the other markets around the world, all of them are going up. And so we will actually have a record year in terms of number of deals that we'll sign. Now, more of those will be overseas than last year, but we'll have a record year for that, and we'll also have a record year for openings. By the way, next year, in the guidance we gave for our unit growth next year, will be yet another record year in openings on a global basis. So the core algorithm of our business, which is taking same-store growth, adding new unit growth, and delivering bottom-line growth, is doing exceptionally well. It's a very resilient model, particularly in a world where we spun the real estate and the timeshare businesses out. And Chris, our growth is great right now.
It is great, but let's talk about China. The market is obsessed in better understanding what is exactly happening on the ground in a key market like for the hotel sector, which is China. You just got back from Asia. What are you seeing on the ground there? Any signs of a slowdown?
Not really. The third quarter was a little bit slower in China, but I think that was entirely related to a bunch of weather-related items related to typhoons, etc. It was still very strong. We still expect same-store results to be up in China 11% this year. Our development deliveries will be up 25 to 35%, depending on how much gets done between now and the year end. And next year, we think we'll have another very healthy year. Now, I did say on the call, as you heard, we built in an expectation of a little bit slower growth in China next year, just because the expectation that their overall economic growth rate will come down. But to us, that still means we're going to be in the high single digits for growth, same store in China.
So you're expecting a slowdown in China, but what about tariffs? Are you expecting a boycott from Chinese consumers as U.S.-China trade relations suffer?
We do not sense that in any way. I talk to my teams literally twice a week. Are we seeing any signs of impact from the trade wars, either in our operating business or in the new development pipeline? And I'll say so far, we've seen zero impact from that.